Welcome to the Commercial Real Estate Show. Thanks for joining us to lead, learn, and laugh. I'm Michael Bull, your host to the world of commercial real estate. Well, today we have the pleasure of discussing Emerging Trends in Real Estate 2014 with Mitch Roschelle and Andy Warren with PricewaterhouseCoopers, or PwC. Emerging Trends is a publication of PwC and the Urban Land Institute that provides an outlook on U.S. investment and development trends, real estate finance and capital markets, property sectors, and then metropolitan areas and other real estate issues. The report draws on formal and informal surveys of real estate executives, investors, developers, and market experts around the country. Their survey responses are from over 500 real estate executives and personal interviews with over 150 industry leaders. And of course, they also use data from trends and history in the real estate market and the current market. Mitch, Andy, thanks for joining us today.
Thank you, Michael.
Thank you, Michael. It's great to be here.
Well, thank you guys for joining us. And Mitch, to help our listeners and viewers get a perspective on what you're actually sharing with them today, how long has Emerging Trends been around, and why is it so anticipated and respected out there?
Well, this is its 35th year, so it's the longest standing industry forecast, and you got it right on the front end. It's Emerging Trends 2014, so the publication is predictive in nature, and you got it wrong. However, we interviewed and received surveys from over 1,000 real estate market participants, actually from around the world, regarding the North American real estate market. So the one word I would use to describe Emerging Trends is durable, because it's really withstood the test of time in terms of its predictive nature.
Well, what are some of the big themes from this year's report, Mitch? What do you see?
Well, I think the one I'd start with is interest rates. Think about when we were doing our interviews, starting in July and finishing up late September, early October. Interest rates, the taper tantrum, as people were calling it, was on everybody's mind. And one thing that really was glaring was, to an interviewee, everybody felt that the market really was able to shake off a rise in interest rates, because we saw a rise in interest rates during that time period, and it really didn't chill investors' optimism about the asset class. And going into 14 with the reality that rates may be 100 basis points higher, it didn't really seem to dampen people's concerns. And the reason for that is, if rates go up because of something that the Fed does, the Fed's going to do what it does because the economy is improving, and it's really the strength in the economic recovery that has everybody bullish on commercial real estate. One thing I'll just throw in there, just to help color that in a positive light, is if you look at the sentiment index that we have within Emerging Trends, going back historically to 2010, when we asked our market participants for the first time what they thought about the profitability of the industry, 17.7% of them thought it would be good to excellent. Well, if you compare that to today, almost more than two-thirds of the market participants, 67.8%, feel that the prospects for profitability in the following year will be good to excellent. So that really tells you that the rate story really isn't something that's going to chill the market.
So we should all be doing the Snoopy dance then, right?
The Snoopy dance is always a good idea.
So overall,
I'm actually doing it right now in my office. The problem is, we're not Skype, so you can't see it.
Okay. Well, our theme is lead, learn, and laugh, and we'll add dance to that for you, Mitch.
All right, fair enough.
What about development? If sentiment is positive, is development back, and what are your folks saying about development?
Andy, you want to take that?
Yeah, I think development being back, it's back from in certain sectors. You're seeing a lot more industrial development now than you did before. Obviously, the multifamily development is continuing, but in terms of the interviewees, there was a lot of optimism that not only the people who wanted to develop were developing, but the people that were going to provide the capital were interested in hearing the story. So you had both sides talking, and it was getting there. And just a general agreement that fundamentals were to a point where development was going to begin to make sense, or it's that period where you want to start talking about it. If you wait too long, you miss it. So it's a lot more positive feedback in terms of what they were hearing on development.
And the one thing I'll pile on the back end of that is, and I know, Michael, you're Twitter friendly, so we have a slide that says tailwinds are the new headwinds, and I think that that's a big reversal of course here, where there's enough positive momentum from a corporate profits, from a housing starts perspective and economic growth to really drive the economy forward and pull the commercial real estate sector along with it.
I mean, that's a good point. I mean, if construction comes back, that helps a lot of people because you've got more transactions, and that really helps everybody involved in this industry, doesn't it?
Yeah, and what's interesting is if something bad is a vicious cycle, something good is a virtuous cycle. The construction industry really drove a lot of our economic expansion prior to the crash in the market, and if we see housing starts and commercial real estate development taking hold, that'll be helping the economy, which will be helping the asset class. So it's a really good cycle if we can find our way into it, and I think we're going to start to see some cranes in the skyline.
And I'm looking at your chart on business prospects improve. So talk to us about who is bullish on the market and maybe who is not out there of the groups that you talk to.
I think that lenders are more bullish. Developers, I think, are always bullish. The brokerage community, and we'll probably talk about that in a later segment, has a positive sentiment. I think the bearish ones, I think that there's, I often say there's got to be a buyer and a seller at every transaction, so there's always somebody on the other side of a trade. I think there are some buyers out there that when they're interviewed for a publication like this still wear their bear costume and not their bull costume. But the fact of the matter is when they sell the asset and they have capital, my guess is they're still investing in commercial real estate.
Right. They may be poo-pooing the market, but they don't want competitors out there, right?
Exactly.
Well, and Mitch, you talked about the residential construction and that boom coming back. Is that sustainable, and how much will that help commercial real estate?
Well, I think it's clearly sustainable because the trajectory of recovery in housing isn't that steep, and it's gradual, and it somewhat mirrors the economic recovery that we're having as a whole. But there's two sides to that. There's jumps in price of homes, which is driving some of the activity, and that's more of a supply and demand story. But then there's the construction starts, and if you look at housing data, it can be a little noisy month to month, but we are seeing a bit of a secular trend in terms of folks jumping back into the housing market, and I think that that's going to have a positive knock-on effect for commercial real estate.
Okay, so you think the funds that have bought a lot of houses and in some markets maybe driven up the price a little bit, and of course the demand, you don't think that's going to have an impact on the residential housing market?
I think it's more about affordability, and I'll let Andy talk about the Home Affordability Index, because I think that's really what the story's about.
Yeah, we look at the numbers, and housing probably hasn't been more affordable in the last 20 years. And we're kind of at a point in the cycle where as the economy improves, we're seeing more people getting jobs, we're seeing incomes go up, and even banks' willingness to provide mortgages, it's beginning to ease a little, or the restrictions are easing a little bit. So you've got a combination of rising incomes, affordable housing, the ability to get a loan, and so we're starting to see more people want to buy houses, and that is pushing up prices a little bit. So you kind of get a tipping point as if affordability kind of tips the wrong way. But right now, it's very affordable. Anybody that can buy is feeling comfortable enough to go out and buy, and that's kind of keeping the market going.
Well, what is the sentiment on affordability as it relates to rising interest rates in housing?
It comes down, and Mitch probably has a better take on this, but it comes down to how much it moves the payment. And you have to have interest rates move significantly. I think it's more of a shock when people hear about rates going up, and they may pull back for a month or two. As Mitch mentioned, the housing data is very noisy from month to month. But once they kind of get into that context and get comfortable with it again, they come back to the market. And I think we saw a little bit of that in this year.
Well, but the corollary is, what are rents doing if you aren't buying a home? because we have, and I know our friends from Reese were just on your show. We've got a multifamily vacancy rate that's at an all-time low. We have housing formations that are back. People have to live someplace, and I think that buying a home, if deemed affordable, is a positive alternative to renting.
Absolutely. And we're going to get into some of those rents and cap rates. So we'll take a break. More on Emerging Trends 2014. I'm Michael Bull. This is the Commercial Real Estate Show. The Commercial Real Estate Show is brought to you in part by your friends at Bull Realty. When your business requires proven performance, visit bullrealty.com or call 800-408-BULL. Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. If you'd like to know the absolute latest on any commercial real estate related topics, check out our on-demand show podcast. For example, we just produced a show on the apartment market and a show on retail and retail real estate. There are lots of interesting shows to choose from. Just grab your cell phone and visit iTunes or commercialrealestateshow.com. Well, today we're discussing Emerging Trends in Real Estate 2014 with Mitch, Roschelle, and Andy Warren with PwC. And guys, what is another one of the major trends that you heard doing this report?
Well, last year we talked about the chase for yield being something that was driving activity in 2013. In fact, it probably started to reverse course when rates started to pick up. But we dug in with the question, and one of the things we do with our publication is we challenge ourselves to figure out if what we said last year was right. So in the interview process, we really dug in with the yield chase. And what we found is there's a new trend emerging, which is there's as much appetite for real estate as there was last year, but it's not yield for yield's sake that's driving people to the asset class. It's really the quality of real estate-related cash flows that's of top of mind for investors. So one of the things we did was we talked about the notion of authenticity. If you think about the fundamentals that are driving returns, we've got occupancy heading in the right direction, and we have NOI growth heading in the right direction, and the prospects for continued improvement in real estate cash flows is what's attracting investors to the asset class, not just yield for yield's sake. So something we've seen in the last couple of years is value appreciation driven largely by cap rate compression, but the income component really wasn't there. And I think that there's probably a chart up right now while I'm speaking, which really speaks to the fact that the trajectory of the lines from an occupancy perspective and an NOI growth perspective are really there, and it has investors interested in investing.
Yeah, and what are the expectations for increases in NOI?
Andy, you want to take that?
I think minimal, or not minimal, I guess. You take a baseline of 3%. We're looking at going over the next 3 years anywhere from 4 to 5% growth in NOIs on kind of that's an aggregate of all the property types kind of rolled together. So, it's not double digit, but it's significantly more than we've seen in the last 5 years. So it's enough to get people excited.
Yeah, it's very positive. That's what people are looking for. If they're looking for the cash flow, they're going to see those increased cash flows. And what effect, you talked earlier about interest rates and their effect on some of the markets. Let's talk about that a little more, if you will. What do the interviewees tell you about interest rates, and particularly into resale values and how it's affected their decisions to buy investment properties?
I think that the good news on rates is that if the trajectory of the curve of the increase in rates is something that is scalable, meaning you can climb up it without having your heart rate go anaerobic. If you were walking up a hill, I think that the asset class and investors in it will be able to handle it. And what I mean by that is if we see NOI growth sort of keeping pace with an increase of cost of capital, I think that the market can digest it. The other thing we're hearing, though, when we talk to lenders is that underwriting standards are getting a little looser, and spreads are compressing because the profitability in banks is improving and banks are chasing real estate loans. So if we have competition amongst lenders and we have free capital flows. I think that the increase in rates won't be that great. And I think there's something to remember, and we heard this loud and clear from our interviewees. If you look at real estate investing over time, we did more real estate activity when rates were 400 basis points higher than they are right now. So it's not the cost of capital that is a concern to market participants. It's the availability of capital. And if it's available, the market will move forward. When we've had crashes in the real estate economy, it's because the spigot of capital dried up.
And how do your interviewees feel about the underwriting and the accessibility of capital right now?
I think by and large they're somewhat bullish on the accessibility of capital, and we measure this a bunch of different ways. But by and large, we've seen year-over-year improvement in the outlook that our market participants have on the accessibility of both debt and equity, and the underwriting of those outlays by the folks who provide the capital.
And where's the majority of this lending money going? Is a lot of it still going to multifamily, or is it getting spread around a little bit to the various sectors?
Yeah, there's obviously the significant portion is going to that, but there is capital available for instance, we talked to some interviewees for retail projects in secondary markets who are now finding capital available that maybe 2 years ago or a year ago was much more difficult to get. So it is beginning to go to other property types and projects. And I think that goes along with lenders being more comfortable with the asset class and beginning to expand kind of the universe that they're willing to look at in terms of deals.
So they feel better about the underwriting. How about underwriting for new construction, new supply?
As long as there is a story, there still has to be a story. It hasn't gotten to the point where they're going to take your word for it. I think one interviewee kind of used the example of a cat doesn't jump on a hot stove more than once, and he says at some point it won't jump on a cold stove either. And he used that to kind of illustrate banks kind of got burned a little bit by development financing. So they're still being cautious, but now they're to the point where they are listening again and actually would like to do more development lending. It's just the fundamentals are kind of not quite there yet that they're comfortable really ramping up.
I see. And how about sources for capital now? Where are the sources coming from? Where do people feel like they're going to be able to get investment capital and loans?
Probably what we're seeing in terms of an increase is the regional banks was one that a source that people think will contribute more in the coming year as they look forward. National banks obviously have still been active, but the regional banks I think will be more active. And they're a strong belief the CMBS market will help fill part of that need, and especially in secondary markets and maybe some product or property types that have a little bit more of a story behind them.
Yeah, clearly the CMBS story is going to be a big one in 2014. It led the list in terms of lending sources for 2014, and it really has been a laggard in past year's surveys. So I think that's the story. The ability to price bonds and sell them really sort of underpins the fact that there is liquidity. And if banks have to compete with CMBS, we'll see bank lending as well. The other source that I think is a story, and maybe it's going to be a huge one in Emerging Trends 2015, so you heard it here first, is shadow banking. And it's the role that funds that are aggregating capital and putting them out in the form of somewhat conventional financing will play in commercial real estate. I think it's going to become a bigger and bigger story in the months and quarters to come.
Okay, and we're at a break here, but if you happen to be listening to the show on the radio, when you can, get to YouTube and check this out, because the charts that these guys are talking about is incredible. You can see what's going to happen in the years ahead. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you in part by France Media. France Media provides exposure to the world of commercial real estate. Visit francemediainc.com or call 404-832-5600. 888-8262. Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. Each week here, we focus on a topic of interest to business owners, entrepreneurs, and real estate people. Be sure to catch shows of special interest to you. Sign up for a once-a-week email announcing the show topic at commercialrealestateshow.com. Today, we're discussing emerging trends in real estate in 2014 with Mitch, Roschelle, and Andy Warren with PwC. And Mitch, you mentioned, I think, briefly the millennial population earlier. What is the significance of the millennial demographic to commercial real estate and apartments?
Well, let me start first with what I'll call a mega trend. And one of the things we're doing at PwC is really studying the top mega trends that are going to drive world economies. And one of them deals with demographic shifts, and I think that there's a real estate story underneath it. In 1950, 8% of the world population was over the age of 60. In 2000, it was 10%. But in 2050, that's going to be 21% of the world population. So we're really heavily focused on the population of millennials. I'll let Andy sort of describe what the millennial population is, and then really talk about what that means for commercial real estate.
Yeah, the millennial population, people have been talking about it for years. Sometimes it's called Gen Y, millennial. It's kind of that group that's coming of age now, graduating from high school, college, entering the workforce. And you mentioned apartments, which is kind of the first thing that comes to mind, where they want to live. They want to live in an urban area. They don't want to drive. We have a chart that looks at kind of the drop in licensed drivers under the age of 24 and how that's been decreasing. They want to live, they want to work, and they want to play in the same area. And this is really beginning to have an impact on neighborhoods in major cities. But it's impacting cities that you wouldn't expect. A market like a Las Vegas is kind of booming now, but it also has the number one growth rate in that age group of younger people kind of moving into it. And it expands significantly beyond just apartments, because many of the interviewees we spoke to this year regards to office, they are reconfiguring their offices, going to the more open, collaborative floor plans that allow people to kind of just come in, you drop your backpack, you work. One person used the example, it's like going to work at Starbucks. You're kind of right there, and you're kind of sitting less of the structure and the formal offices. And they wildly admit that they have to do this to retain this group if this group has a skill set that they want. So it's not really so much just people are skeptical and say, well, you're just doing that to cut your square foot per worker and it's cheaper. It really isn't that. They feel it's more of an HR cost, which is much more significant than the real estate cost in their total business model, and they have to do it to compete. So we're hearing that. And in retail, a lot of the retailers that we spoke with mentioned that the growth area is following this group back into the urban area. It used to be suburban expansion, putting up shopping centers. They expect that to come back as the housing market recovers and won't completely go away, but they're spending a lot of time now designing formats that will work in urban areas. Maybe it's a two-story store or something that kind of will cater to this group. So we're seeing, kind of that impact all across, and then that filters into the industrial sector where, you're setting up, they're buying more things online, so you need more fulfillment centers. So we found that it touched much more than apartments, but really spread across all the major property types.
And two things to remember. The cohort that we're calling millennials or sort of Gen Y is 28.5% of the U.S. population. So It's the single largest cohort, and we're defining that as 15 to 29-year-olds. So if you think about the decisions around commercial real estate, shopping, living, all are going to be made in the years to come by that cohort as the newest entry into the housing market, the shopping market, et cetera, et cetera. One other thing that Andy talked about, which I wanted to circle back to, which is part of this urbanization theme, and it's another one of the mega trends that we at PwC are focusing on. By the year 2050, there'll be a 72% increase in the population of urban areas around the world. So One of the things that market participants talked about in this year's survey process is the urbanization of suburbs and the ability to turn areas that were once upon a time rural and then became suburbs into having an urban feel, to Andy's point, with people who don't want to have cars. So the proximity to transit hubs, the ability to allow people to, work, live, and play in close proximity is really going to be driving the decisions, and is something to watch closely.
So I guess we'll have a lot more mixed use as we give up briefcases and get into backpacks, right?
Yeah, exactly. You can put everything in there.
All right, we're going to take a quick break. When we get back, we're going to talk about some of the top markets in the U.S. with Mitch, Roschelle, and Andy Warren with PwC. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you in part by your friends at Bull Realty. When your business requires proven performance, visit bullrealty.com or call 800-408-BULL. Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. You're invited to check out Commercial Real Estate Show TV. Yes, visit YouTube and search for the channel Commercial Real Estate Show, especially for shows like we're doing today, where you've got some excellent charts that not only look at where we've been, but where we're headed. Today, we're discussing emerging trends in real estate in 2014 with Mitch, Roschelle, and Andy Warren with PwC. And Andy, what are some of the top markets geographically around the U.S. where investors wanting to place their money in 2014?
It was the survey this year for the results. It turned out to be a little more of a diverse group than we had seen in previous years, which I think was good. Obviously, we're still seeing tech markets continuing to lead the pack. San Francisco, San Jose, very high on our list of markets for this year. But you also throw in the state of Texas, which is seeing an economy grow far above the national average. Dallas, Fort Worth, Houston, Austin, all in the top 10. You throw San Antonio in the mix, which is in the top 20. You've got all four major metro areas of Texas as top markets for this year. Another change that is kind of notable is we saw markets like Orange County, California, and Miami move into the top 10. Those are markets that were beat up pretty badly by the housing bubble bursting. They've worked through those issues. I think people view them as attractive places to live. They've got fairly diverse economic bases, and people are beginning to look at those markets again and find some value there. So those were kind of the top 10 markets that we saw this year. One thing that we talk about in the report, which is a little notable, is kind of the decline of Washington, D.C. Washington, D.C. slipped into kind of the bottom middle of the list of markets that are highlighted by investors this year. And, we think it's really due to kind of Fed fatigue. That market was so strong during the downturn because the federal government held up. Now we're seeing kind of what's going on with the fiscal cliff talks and the budget ceiling talks and all the uncertainty about regulation coming out of Washington. And it's beginning to have kind of a blowback effect on that local market. And it doesn't hurt the fact that a lot of money did flow in there, so you're seeing new development kind of going on. So I think investors are taking a wait-and-see approach to kind of see how the market absorbs that, see if anything kind of straightens out with the federal government and how that might impact the economy going forward.
Yeah, that's a very interesting market in D.C. We did an interview with a big tenant rep there in D.C. called Office Tenant Strategies, and it's interesting to hear about that market. If you haven't heard that show, check it out. And let's talk about the office market, guys. How do your interviewees, how do they feel about the office market moving forward?
Yeah, I think fairly positive. I think we talked about the trend that the office market is going through a little bit of an evolution. Obviously, Central City CBD office is more attractive right now than suburban. In fact, that would be some of the most negative comments that we heard from interviewees were about suburban office locations. And I don't know if that was they were caught up in the moment of their conversation and were thinking about the millennials and everything being urban, but the sector is kind of beaten up, and that it'll have to kind of redevelop. And Mitch touched on this a little bit, kind of that reurbanization of the suburban location. But in terms of office, the demand is back. Office employment is growing, and we heard that not just from energy and tech companies, but there's talking some financial service growth in markets around the country, starting to kind of backfill some of this. Not your tradition, or more of your financial planner, kind of that local user is kind of growing, so we're seeing demand from that. So the office sector, a little bit of a mixed bag, I would say, with the central city and CBD being more attractive, and suburban probably trailing a little bit in the cycle.
And Michael, maybe this is near and dear to your heart, being amongst other things in the investment sales business yourself, but one of the things we look at is the buy, hold, sell barometer, if you will. So CBD, there's more buyers than there are sellers. However, in suburban, there's a lot more sellers than there are buyers. I think we may see more transaction volume in CBD office and rising prices and compressing cap rates in 2014.
Yeah, that's an interesting slide that you have there. I mean, it's a very segmented recovery, isn't it? So there's a lot of opportunity out there, and I guess if there's more sellers in those suburban type properties, maybe some of those Class B, there may be some good opportunities, right?
Yeah, and when we look at some of the markets that moved, we ranked the top 50 markets in the country. Some of those historically suburban markets that are sort of proliferated with suburban office product have fallen down a little bit in the rankings relative to those markets that are more sort of emerging in terms of their economies. So I don't think suburban office is dead. What I think is happening is your father's suburban office needs to be repurposed for it to be of interest to the millennials.
And I think that is a trend we did hear from people, that with the suburban office market and the condition that it is, it offers the opportunity to go in, buy a building, and then maybe get it at such a basis that you become kind of the dominant landlord in that submarket. And you can it's actually, that may be a play that makes suburban attractive in the near term.
Yeah, I think there's a good opportunity in the office investment market for sure. Well, we're going to take a break. When we get back, we're going to talk about industrial properties and warehouse properties. We're also going to talk about retail and what the interviewees feel about the retail market. So stay tuned for Mitch, Roschelle, and Andy Warren on Emerging Trends in Real Estate for 2014. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you in part by France Media. France Media provides exposure to the world of commercial real estate. Visit francemediainc.com or call 404-832-8262. Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. Thanks for sharing the show on Facebook, LinkedIn, and Twitter. We do very much appreciate it, and I think your friends and followers will as well. Well, today we're discussing Emerging Trends in Real Estate 2014 with Mitch, Roschelle, and Andy Warren with PwC. And Andy, there seems to be a lot more buyers for warehouse properties than there are sellers. What's driving demand there?
I think slowly the fundamentals for warehouse improved much faster than people anticipated it would. I think it started with the economic recovery and the import and export of goods. Those markets benefited. The explosion in online retail and selling, so it drove demand for fulfillment centers. So we saw it from that end, so the market began to improve. And then we're now beginning to see the smaller side of the market improve with the housing market improving. So things are just getting better in warehouse, and to be honest, there's a lot of warehouse that's going to be obsolete. So there is a demand for new space, even though maybe the vacancy rates aren't as low as you had anticipated that. So that's really kind of piqued everyone's interest in industrial right now.
Yeah, well, that's a good point. And I'm going to say this again, but if you're listening to this on the radio, you might want to listen to it again or watch it on YouTube so you can see these charts from this report. It's really excellent. And Mitch, let's talk about retail. How do your interviewees feel about retail real estate?
Well, Well, from a sort of buy, hold, sell perspective, it's really all about neighborhood and community centers, and that's really tied to the housing resurgence. But the other thing to think about, and I'm going to tie into what Andy said, retail sales are on the rise. They're not necessarily in stores because the trajectory of growth in the online retailing is very predictable. It just keeps going up. But the fulfillment centers of tomorrow aren't necessarily the fulfillment centers of the past. Think about warehouses. What's happening is stick and brick retail is actually becoming the fulfillment center for many online purchases, because if you buy online as opposed to buying in the store, that instant gratification just isn't there, and you can't go home with the item, so you want it quickly. Well, what's the closest place to deliver it? The store itself. So there are some big electronics retailers, some big office retailers who actually fulfill online orders out of the closest store with their own trucks and get it to you, in some cases the same day. So I think we're going to see sales activity and the use for traditional stick and brick retail helping drive the online. So the two components of retail sales are working in concert for the first time, going to create demand for commercial real estate.
Well, that's fantastic. And that instant gratification, it's really true. I mean, I bought a TV last weekend. It was too big to get in my car, and I can't take it with me. I don't really want to buy it then.
Yeah, exactly.
It was either too big. Well, it's either too big to fit in your car, or your car is too small. One of the two. So you could have also bought a new car to solve that problem.
I got one of those little tiny smart cars, right?
Yeah.
Well, guys, your interviewees feel more positive this year than they have in past. Does that mean we're going to see a lot more transaction volume?
Yeah, if you look at the overall buy, hold, sell sentiment across all property types in all markets, I think it leads to an uptick in transaction volume, and maybe that's what many of the interviewees wanted to hear, so they Ouija boarded it that way. But when you have 1,000 people who participate in the survey, it's really difficult for one constituent group to create self-fulfilling prophecy. I don't think we've been wrong in the last couple of years in terms of our predictions on transaction volume, and this year the survey is suggesting an uptick, and history would tell us that it's probably correct.
Well, it is an excellent report. I urge everyone out there to read it. Mitch, Andy, thanks for joining us today.
Thank you, Michael.
Thank you, Michael.
For more information from Mitch, Roschelle, and Andy Warren and the good folks at PwC, visit PwC.com. Well, can you join us next week? Well, I hope so. We'll have a good look at the industrial market. You heard what's happening there. Get to know more about it. There's some opportunities there. Thanks for joining us today. I'm Michael Bull. Until next week, be sure that you always lead, learn, and laugh, and join us for the Commercial Real Estate Show. The Commercial Real Estate Show is brought to you by your friends at Bull Realty, France Medio, Atlanta Office Liquidators, and Wiseman, Nowak, Curry, and Wilco. For more information about these companies or to access additional show podcasts, videos, or blogs, visit commercialrealestateshow.com.